Did you know that Canada is anticipated to rank among the top G7 nations in GDP, population, and employment growth over the next 5 years? This is a promising sign for the multifamily real estate sector and beyond. Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. Today's topic is the Canada real estate market outlook for 2025 based on a comprehensive report by CBRE. As we stand at the cusp of 2025, Canada finds itself at an inflection point on multiple fronts, politically, economically, and socially. Despite these challenges, the country remains a beacon of growth in the G7, with GDP, population, and employment growth all projected to be at the forefront. This positions Canada as a significant player in the commercial real estate domain. The real estate market is poised for increased activity in 2025. The cost of capital crisis is expected to ease, which, contingent on global bond market conditions, will likely lead to a surge in investment and leasing activity. Leasing fundamentals are improving, although Canada has seen a notable increase in new supply across the office, industrial, and residential sectors, which will require some time to absorb. For multifamily real estate, the outlook is quite intriguing. Despite near-term uncertainties due to immigration curbs and new supply deliveries, the long-term growth fundamentals remain robust. This presents a compelling investment thesis for those looking to expand their portfolios. It's important to remember that while challenges exist, they often come with opportunities for those who are prepared and informed. In the industrial sector, we are witnessing some headwinds due to softer demand and an influx of new supply. However, the market is expected to work towards normalization, which could happen sooner than many expect. This sector, much like multifamily, has its challenges, but also its silver linings for strategic investors. The office market is also at a pivotal moment. Occupiers are shifting back into a growth mindset, leading to a potential recovery. The focus is on flight to experience, with a slowdown in new supply creating an undersupply of modern, amenitized, and environmentally sustainable buildings. This could be an area of opportunity for developers and investors alike. Retail is seeing positive leasing intentions, yet the supply-constrained landscape is pushing retailers to consider expanding into secondary markets and altering their store formats. This adaptation could open new avenues for growth and investment in the retail sector. Overall, Canada's real estate market in 2025 is set to be vibrant and full of potential, even in the face of certain challenges. As always, staying informed and agile will be key to success in this ever-evolving landscape. Remember, every challenge is an opportunity in disguise. Stay tuned as we continue to explore these insights in depth. In today's news segment, we're diving into a recent report by Oxford Economics, which highlights some pressing challenges in the Canadian multifamily real estate market. According to the report, the market is being squeezed by a combination of new supply and international trade tensions, particularly with the United States. Oxford Economics notes that Canada's average national asking rent has experienced a decline, with a drop of 3.3% compared to the same period last year. This decline is most pronounced in cities like Calgary, Vancouver, and Toronto, where rents have fallen significantly. The surge in new multifamily unit completions, which jumped 35% in 2024, is adding substantial new supply to the market. Oxford Economics predicts that this trend of strong rental supply growth will persist as more purpose-built rental units are completed and integrated into the housing stock. However, the demand side is seeing some challenges. Slower immigration and a reduction in temporary residents are curbing rental demand. Despite these factors, Oxford Economics suggests that worsening homeownership affordability and financial pressures on households, exacerbated by the ongoing trade war-induced recession, will likely support rental demand to some extent in the coming quarters. Internationally, the trade tensions between the United States and Canada are having a ripple effect on the real estate sector. Former President Donald Trump had threatened to escalate the trade war unless Canada withdrew its digital service tax targeting U.S. tech giants. Although Canadian Prime Minister Mark Carney's government has agreed to resume negotiations, the uncertainty remains a concern for the industry. Tony Stillo, Director of Canadian Economics at Oxford Economics, expressed concerns that unless a deal is reached soon to alleviate the tariffs, the housing slump could extend through the end of 2025. He emphasized that poor affordability, weak consumer confidence, and job losses from the recession are likely to continue impacting demand. Additionally, immigration cuts are expected to further contribute to an increase in the supply of homes for sale, potentially leading to a decrease in average prices by 8 to 10% by the year's end. CoStar Market Analytics provided additional insights, noting that market vacancy rates are approaching more balanced levels in highly unaffordable urban markets like Toronto and Vancouver, while moving towards cyclical highs in Alberta. This rebalancing offers a glimmer of hope in an otherwise challenging market landscape. As we wrap up this episode, it's clear that the Canadian multifamily real estate market is facing a complex set of challenges. Yet, as always, there are opportunities for those who remain informed and adaptable. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.